Hello and welcome to CMC Markets on Tuesday, the 2nd of July, and the weekly market update, and welcome to Q3. And it's a big week this week, albeit quite a short week, certainly as far as US markets are concerned, because essentially it's all about central bank meetings, notably from the ECB and the Bank of England, and obviously US payrolls data in light of the recent will they, won't they taper discussion. So these are the key factors I'm going to look at this week, and I'm going to be looking at predominantly the performance of the actual US dollar against the euro and the improvement in economic data that we're sort of seeing this week, particularly out of Spain and Italy. Yes, unemployment still remains high, but we are seeing a bit of an improvement in the manufacturing sector. Spain's manufacturing PMI came in at 50, and Italy's manufacturing PMI came in at 49.1, both above Germany's, and it's been a long time since that happened. Germany's manufacturing PMI stagnated just above 48, and that's sort of helping to underpin the euro, despite the fact that unemployment still remains very, very eye-wateringly high. So we're going to look at euro dollar. We're also going to have a look at the US 10-year note and the yield, and you may recall I looked at that last week. So far that key level has held, and we're also going to have a look at a gold chart as well to see whether or not we found a base or whether or not we can see any further losses going forward. Okay, so let's start with euro dollar. We're looking at a daily chart at the moment. It's over the course of 1 year, and we can see from the trend line that I've drawn in from the recent lows that we've got trend line support coming in around about 129. 50-60 area, and I think that's really the key level that we've got to keep an eye on with respect to the decline in euro dollar. I think it's also important to keep an eye on the oscillator and what that's doing. It's looking extremely oversold on the daily charts. That doesn't necessarily mean that it's going to bottom out, but it is an indication that at the moment euro dollar does appear to be in a range, and we could be near the bottom end of that range. Currently it's finding resistance around about the 130.90, 131 area, which is essentially where you've got the confluence of the 50, 100 and 200 day moving average. So there's not an awful lot of excitement there with respect to euro dollar. Maybe Mr. Draghi will introduce some volatility at Thursday's central bank meeting. One important thing to remember about Thursday is the US won't be in, so volumes could be quite considerably lower and volatility could be quite considerably higher. So that's one important factor to bear in mind going forward. Moving on to the US 10-year note chart, and specifically the daily chart. Now, last week I identified the hammer on the daily chart, which suggested that we may well have seen a short-term base. Now, the base that we're talking about is the equivalent to around about 2.65%, 2.7% on a yield basis on the 10-year US Treasury. We do appear to have found a base. Now, if we now move along to the weekly chart, which I'm about to display here, which basically comes in between the 125 and the 126 area, and also the 200-week moving average. That continues to remain a very key level on a closing basis. So those of you who believe in the taper argument, we really do need to see a break above 2.7% on US yields, and for that price support area to break. Currently it's not breaking, therefore we do remain susceptible to bounces in US Treasury prices and pullbacks in yields. Which brings me neatly on to gold. Now, gold prices have come off significantly over the past few days and the past few weeks. We do appear to be finding a level of support, and I only say a level of support because I think if the tapering argument continues to feed into market chatter, and that could really be decided by this week's payrolls data, and as well as the ADP data that we're expecting tomorrow. ADP data we're expecting a figure of around about 165, 170 from last month's 135. Non-farm payrolls we're expecting a figure of around about 175, which is more or less in line with the 178 that we saw in the previous month. The unemployment rate we're expecting to come down from 7.6 to 7.5. If any of those numbers come in pretty much anywhere near expectations or anywhere near 200,000, then the arguments for speculation about imminent tapering this year are going to grow an awful lot louder, and that's going to send the dollar it's going to make the dollar even more supported than it currently is. So looking at the gold price, we have seen a bullish engulfing day on the daily charts, but to stabilise we need to see a move back above the $1,300 mark. Otherwise we're going to be heading towards, or the likelihood is that we're likely to head towards the 1150 mark, which I've been targeting for quite some time. It's also 61.8 retracement of the entire up move from the 2008 lows at $680 to the all-time highs at 1920. I'm going to finish up this week with a quick look at the UK 100 chart, because I think it's something that really does bear looking at. Let's look at the monthly chart for the last few months, and we can see from the May and June candles there's some very long upper and lower shadows on both candles. Now that does seem to suggest that we could well have seen the highs in the medium to long term. I think really the question as to whether or not we have seen the highs will depend A, on future US economic data, and B, concerns about a slowdown in China. Now if we move on to the daily chart, we can see that a few days ago we saw a bullish daily candle, and that has prompted the current rebound that we're seeing at this moment in time. Now there is a potential from the line that I've drawn on the chart, on the daily chart, that we could see a rally back to 63.50, 63.60 from the lows that we saw a few days ago. The question is, can we sustain the current rally? Again, it really comes down to perceptions about future US monetary policy and how good future US economic data is. But I would suggest that the UK 100 has got potential to squeeze a little bit higher, but it really does need to get back above the 63.50, 63.60 area, that trend line resistance that I've drawn on the daily chart. Okay, so that's pretty much it for this week. Once again, thanks very much for listening. Looking forward to Friday's non-farm payrolls at 1:15. Until next week, this is Michael Hewson talking to you from CMC Markets.